Company taxation in Malaysia offers opportunities for businesses to thrive in a vibrant and diverse market. Understanding the country's corporate tax structure is key to navigating the financial landscape effectively. Malaysia operates under a territorial taxation system, meaning companies managed and controlled from within the country are taxed on income derived from Malaysia, including profits, dividends, interest, rents, royalties, and other earnings. When you register company in Malaysia, gaining insight into these tax nuances is crucial for making informed business decisions. What is corporate tax rate in Malaysia? Corporate income tax, also known as company tax, is a direct tax on profits earned by companies in Malaysia. This tax applies to both resident and non-resident companies deriving income from within the country. However, for small and medium enterprises, SMEs, with paid-up capital of RM 2.5 million or less, a reduced rate of 17%, lowered from 18%, applies to the first RM 600.000 of income. Any income above this threshold is taxed at the standard rate of 24%. Understanding these rates and thresholds is essential for efficient tax planning and compliance in Malaysia's corporate tax environment. Different types of company taxation in Malaysia. 1. Withholding tax. In Malaysia, withholding tax applies to payments made to non-resident individuals or companies for services rendered within the country. The rates vary based on the type of payment. For instance, contract payments are subject to a 10% withholding tax, interest payments incur a 15% rate, and royalties are taxed at 10%. Companies should be mindful of these rates when making payments to non-residents to ensure compliance with company taxation in Malaysia. 2. Payroll tax. Under company taxation in Malaysia, employers must retain a portion of employees' remuneration, including bonuses, incentives, and salaries, and submit it as monthly tax deduction, MTD, to the Lembaga Hasil Dalam Negeri Malaysia, LHDN. This payroll tax must be paid by the 15th of each month, based on the remuneration from the previous month. Companies must adhere to this schedule to ensure compliance with tax regulations and avoid any potential penalties. 3. Stamp duty. In Malaysia, stamp duty is a tax paid when handling legal, commercial, and financial documents, such as partnership agreements and mortgage contracts. Stamp duty rates can either be fixed or vary depending on the type of document being dealt with. As part of company taxation in Malaysia, IT is important for businesses to understand the specific rates and rules that apply to different instruments to ensure proper compliance and smooth operations. 4. Sales and services tax. Sales and service tax, SST, applies to manufactured or imported goods. The sales tax rate is typically 10%, while the service tax rate is set at 6%. However, certain items such as face masks, medical equipment, and disposable items are exempt from service tax. Understanding SST is essential for businesses to manage their tax liabilities effectively and ensure compliance with Malaysian tax regulations. Navigating the different types of company taxation in Malaysia can be complex, but Huimai is here to simplify it for you. With our accounting and tax obligation services, we ensure your business remains compliant and operates efficiently.